Hey, welcome back. Thanks so much for tuning into this video today. I hope you're well, and more importantly, I hope your family and your friends and your community's well during these difficult times. And an especially warm welcome to the 20,000 of you, I'm still blown away by that, new subscribers in the last week alone. You're gonna love the channel, you're gonna love the videos that I put out every single week, so big welcome to the family. In today's video, we're gonna be covering the financial risk of inflation, deflation and hyperinflation in the Western world. So that means the USA, Canada, the UK, Europe, and even, yes, I do read the comments, Australia and New Zealand. I'm including all of you down under. Now, before we can get a good forecast on the economy and what might happen, I first need to cover the fundamentals. So this is inflation, deflation, and hyperinflation, and what this means. So let's start with inflation. There are 5 types of inflation. However, since I don't want to bore you to sleep and I'm not looking to win a Nobel Prize in economics anytime soon, let's just keep this simple, shall we? So what is inflation? Well, very simply, inflation is a decrease in your purchasing power of your currency as a result of rising prices of goods and services. In simple terms, that means the $10 in your pocket loses its purchasing power over time, meaning that you can buy less with it as time progresses. An example of inflation you'll know straight away is snacks. So have you noticed how snacks seem to be getting smaller and smaller and smaller, but the packaging stays the same size? And when you open that bag of potato chips, you feel like you've just been robbed.
Here we go, here we go, here we go. Oh, and there you go.
Most countries aim for a 2% inflation rate, but if it drops below 2%, that basically signifies either like a recession or that there's a slowdown in economic growth of that country. But if it goes higher than 2%, it means that the economy is growing too quickly and your currency decreases in value. This basically means that your weekly grocery shopping becomes more expensive. For example, when I was growing up in England in the 1980s, a loaf of bread cost 36 pence. Now, that same loaf of bread costs £1 and 7 pence. That's an increase of 71 pence in under 40 years. You didn't know I was that old, did you? You probably thought I was just a 14-year-old with a beard talking about finance. While the value of the $10 bill hasn't changed, the amount it can purchase decreases over time and has done for a long time now. The simple reason for inflation is because the monetary supply grows at a faster rate than the goods and services that we produce. During the first few months or so that a country is hit with inflation, most people will go out and make a lot of purchases, often long life food products and the like, and other things that people are going to purchase anyway, because if your currency is devaluing, it simply makes sense to stock up now rather than wait until later when your money's worth less. This is similar to the mentality of panic buying that we've been seeing recently. If there's a chance that you might not be able to buy your essentials, you stock up on them and you hoard them. Inflation, or even the fear of it, causes many people to make longer-term investments such as equities or gold. Many of you have asked me in the comments below numerous times if I'll make a video again on gold and silver, the fundamentals of it, and how to actually use that as an investment to protect your money against inflation. So I've decided I'm going to do that. That video will be coming out in the next 2 to 3 weeks. If you would like to watch that video, just subscribe below, and that way you'll make sure to get it. And no, I don't own a mint and I don't sell metals. I've got no bias behind it. This video will just be to help you out. And if you're already a subscriber, you know what to do at this point in every single video. Please click the like button below for me. I really appreciate your support. It helps me so much with this whole YouTube algorithm thing to get my videos ranked. So thank you so much. When the government puts more money into circulation, this actually benefits them because it helps them to pay off their debt easier because they inflate the debt that's already in existence. But really all this does is it steals the wealth from the middle class and the savers, people who save money in the bank. I'm going to cover more on this very shortly. Inflation hasn't actually been a big problem in the US since the 1970s due to a number of monetary tools that the Fed have, like interest rate rises. However, interest rate rises come with their own big problems. As I said in my video last week, Any interest rate rises that the Fed does, or any central bank that's got very low interest rates right now, are going to have a massive impact on the housing market. Because if they raise interest rates, this will push out the affordability of people that want to buy houses or want to refinance, etc. And this will cause a housing crash because we already have the other variable, which is high unemployment. Housing crashes are caused by two things: high unemployment and interest rate rises. One reason why I don't recommend people keep large amounts of money like savings in the bank for long periods of time is simply because back in the day, banks used to give you a really, really good interest rate. Like really, really good. You wouldn't believe the interest rates you used to get. But now the interest rates are abysmal, like 0.1% if you're lucky. Some of them are 0.01% now. It's crazy. So it makes absolutely no sense to keep your money in a bank for long periods of time, and by that I mean years, because the inflation rate will be eating away at your money. And that's not even taking into account new money creation and quantitative easing. And that's a whole other story. We won't even get into QE today. So imagine that you put $1,000 into a bank savings account where you get an interest rate of 0.1%. At the end of the year, you might think, oh, I'm going to earn $1. Although that's true in theory, it's not actually true in practice. And that's because, let's say that inflation was 2% for the year. Well, 2% of $1,000 is $20. So what would happen is that you've actually lost money on your $1,000 because the purchasing power of your $1,000 is now only worth $980 plus the $1 of interest, so $981. Now let's look at deflation. If inflation is a decrease of your $10, then deflation is an increase of the purchasing power of your $10. Where deflation may be good is when that $30,000 new family car now only costs $28,000. So that's a saving to you of $2,000. But deflation is really bad for the financial markets as well as you if you take out a mortgage or you take out a loan, because it's going to be more expensive for you to pay off that loan, that credit. Falling prices reduce consumption as people hold out on making those bigger purchases, like that new car, for example, because they have the belief that potentially prices might fall even further, as has been shown throughout history. As we discussed on one of my other videos a few weeks back, during the Great Depression, the unemployment rate was between 20 and 32% at its peak. Shadow Stats, which is an alternative government agency, already put unemployment past 20% over a week ago. So already we're seeing commonalities with the unemployment rate of the Great Depression, where we had a period of deflation. During the period of the Great Depression, which was 1929 through to about 1938, prices dropped by roughly 10% yearly between the years of about 1930 and 1933. So it's very possible that the recent health crisis could trigger deflation as a result of the increased unemployment and the reluctancy that people have to spend the little money that they have left right now, which could then reduce the demand for goods and services, which then creates a surplus of those goods and services. If we have too much of a surplus, prices come down. When prices go down, salaries go down too. In simple terms, the cycle looks like this. Step 1, unemployment plus wage cuts equals where we are right now. Step 2, a lower demand for the products and services causes prices to go down. This is due to people having less money. Step 3 then means that falling prices come as an oversupply of these goods and services, plus a lower demand for them. Step 4, this then leads to a decrease in profits in businesses due to the lower demand for their products and services. Step 5 is business closures and bankruptcy, taking us right back to where we started with more unemployment and wage cuts. It's just a negative cycle. With many manufacturing plants and businesses closed or partially closed right now, we're already seeing a very real possibility of shortages of basic necessities. I've already seen this at my house in England. I got off the flight, went to get necessities and the like from my local supermarket, which is one of the biggest supermarkets in all of Europe, and it was stripped bare. Finally, let's look at hyperinflation, which seems to be a favorite word of a lot of YouTubers right now, throwing this around with the classic wheelbarrow of money picture from Zimbabwe. I don't think you can create a video without that picture. Hyperinflation is inflation on a much larger scale. So where we mentioned 2% per year is a good thing, well, economists class hyperinflation as 50% per month or more. When hyperinflation occurs at a rapid rate, that $30,000 family car you were looking to buy could cost $50,000 next month and $100,000 the month after. Just imagine that. The most famous examples of hyperinflation in the last century were Germany, Zimbabwe, Hungary, Venezuela quite recently in 2016, where the wheelbarrow people used to carry their money around was often worth more than the money itself. Sorry, I had to get the wheelbarrow picture in there somewhere. I wasn't a good YouTuber unless I did that. So hyperinflation is usually caused by one of three things. Number one is a weakened economy, such as what happened during World War II. Number two is large government debt versus GDP. Know any countries like that? And number three is an uncontrolled increase in the monetary supply, such as what happened in Venezuela in 2016 and is still going on today. So a good example I can give you of hyperinflation is that last week I went to my local supermarket to buy a loaf of bread, which usually costs £1, but they were out of stock. So instead, on my way home, I went to a local mini market where they actually had one loaf of bread left on the shelf, but it didn't cost £1, it cost £2. That's double the supermarket price. The supermarket owner informed me that she was having difficulties getting supplies in on basic necessities, just like some of the other mini markets in the area, on products like bread, milk, eggs, etc. I willingly paid the £2 for the loaf of bread, knowing it was double the price, because I wanted the bread more than I wanted the money. Now, if this became the norm, that bread cost £2 instead of £1 across supermarkets and mini markets, this would be a 100% inflation, meaning hyperinflation. We also saw this recently with hand sanitizer, where there was about 1,000 times more demand than there was supply. So many people ask, well, can't we just print our way out of financial difficulties? Well, if we look at Germany after the First World War, that's exactly what they tried to do. They didn't want to pay the repatriations, the debts that they owed to other countries, so instead they tried to print more of their money. All this did was hyperinflate their currency and crashed their currency. Because it doesn't work like that. You can't just print money out of thin air, unless you're the Federal Reserve. Many world leaders have found this out the hard way.
We used to think that you could spend your way out of a recession and increase employment by cutting taxes and boosting government spending. I tell you in all candor that that option no longer exists. It only worked on each occasion since the war by injecting a bigger dose of inflation into the economy, followed by a higher level of unemployment as the next step. That's the history of the last 20 years.
If you haven't already clicked the like button below, I'd really appreciate if you could do that for me right now. It would help my channel so much, so thank you, I really appreciate it. A number of people asked me in the comments on last week's video if I agree with, there's a couple of experts out there who have said that the US and other economies around the world are going to go into hyperinflation. So people have asked me what I think of that, so let me answer that question now. The biggest problem is that the US injected trillions of dollars into their monetary supply literally overnight. This is a monetary supply that has taken a long time to build up to where it is. So yes, obviously printing and injecting money into that economy will have an impact of some sorts. A lot of experts and economists have been warning this week that all of this new money that's been injected into the economy is going to have a massive impact and cause high inflation. However, that sounds accurate in theory, but it's not really how it happens in practice. And we've got various examples of this around the world, but the most recent one is in 2008 in the United States. We didn't see extreme inflation because that money was given directly to the banks, and the banks didn't give it out. They hoarded that money. But if it were given directly to the people, yes, then we would have had a lot more transactions. I won't go into the trajectory of money and all these sort of things, but we would have had a lot more transactions, and that would have then caused higher inflation. With the current state of the world, how it is right now, there is a lot of concern about the purchasing power of the US dollar, especially since the US dollar has lost 92% of its value in the last 100 years. So basically, the only reason the USA has been able to get away with this big money printing and increasing their monetary supply is because the US dollar is the world reserve currency. This means that other countries around the world back their currency with the US dollar in the same way that the US dollar used to back its currency with gold. It then came off the gold standard. I won't go into all of that, that's for another day. So if the US dollar did ever go into hyperinflation, it would be pretty much the end of the monetary system globally as we know it. Everything would collapse globally. It would be absolute chaos. So what do I think will happen then? Well, firstly, this is extremely complicated to predict. Even some of the world's top economists don't want to have a go at predicting what will happen with inflation, deflation, hyperinflation, all the other things right now. But since I don't have a Nobel Prize or a reputation to protect in economics, I don't mind giving a go at it, but just remember that this is just my personal opinion. It's not financial advice. So with that said, let me tell you what I think. Based on all the data I have to hand right now available to me, personally, I think we'll go into a period initially of small deflation of anywhere from 0.1% to a few percentage points. I don't think it will go much more than that. And this is as a result of the economy grinding to a halt the way it did. I then think we'll go into a period of inflation of probably about 5%. I mean, that's just my best guess, about 5%. But as I said last week, if it was, say, 10%, that would be really extreme, and I'd be quite surprised by that. But these are unprecedented times. It's not out the question, but I think probably we'll see about 5%. The last time we had anything that's comparable occur like this was in the 1970s, and that is termed as stagflation. You don't really need to know what that means. Stagflation is just what I've just described a moment ago. So I definitely don't think that we're going to see hyperinflation. I think the odds of that happening are so slim that it's not even worth me calculating. So personally, I think regardless of what country you're in, we're all in for a rough ride because of all this money that's been put into circulation by the central banks. The banks do not give grants, just so you know. Central banks, they don't give grants, they give loans. And loans always have to be paid back. And the government doesn't have any money, as I mentioned last week. The government doesn't create any money. They get all their money from taxes. And where the taxes come from, it comes from the efforts that you and I produce. That is really what drives an economy. It's human power and energy and our creativeness and our work. That's what drives the economy. So that's where the money's going to come from. In the end, it's going to come from you and I. Even though the government's making you think that they're doing you a big favor with all this money printing, actually, we're the ones that will have to pay it back eventually. And this is all coming at a time of high unemployment, when your savings are being eaten away by inflation and your wages are also going down as a result of the economic crisis. So here are my final tips then. If you have a mortgage, then inflation is good for you because it inflates away the money that you borrowed initially, meaning that you're paying back that mortgage with cheaper money. But if you're a saver, then deflation is best for you because it means that your money isn't being inflated away every year as a result of inflation. But long term, honestly, the best thing you can ever do with your money is to invest it into something, whether that's real estate, whether that's gold, silver, metals, stocks and shares, as long as you know what you're doing. That's the caveat to what I just said. Please don't take this as financial advice. As long as you know what you're doing. Assets like this will always go up in value over the long run. They always have, they always will do. Even if it takes 10 years before, let's say there's a crash, even if it takes 10 years to come out of that, your money will still be protected because these assets will always go up in value eventually. And if you're invested in short-term speculation, You might want to rethink your strategy right now, because I can tell you I've learned the hard way over the years where several times I've been speculating and I've been hit really hard. So I only do long-term investments now. I never speculate. As you know, I make these videos for you, taking very complex, complicated subjects, and I make them super simple so that anyone can understand. If you appreciate the 50 to 60 hours that goes into making every single video, I would really appreciate it if you share my channel with a friend or family or a colleague, and to just make sure to subscribe if you haven't already. In my upcoming video, I'm going to teach you about safe havens for your money, about assets that you can invest into. And lastly, if you haven't already done it, this is your last chance. Please click the like button below for me. I really appreciate it. I love you guys. Thank you for the support you're giving to me and my channel. And make sure to leave me a comment below. Let me know what you think. What do you think is going to happen to the economy? Do you think my prediction is fairly accurate? Do you think I'm way out? Let me know. I appreciate your feedback. If you want to give me feedback on anything else, please let me know. I do read all your feedback and I take it on board. And it really does help me to make these videos better and better all the time for you. So apart from that, thank you so much for watching. I really appreciate it. See you next week.